Welcome back to the Wall Street Podcast.
Glad to be discussing this today.
We're doing a deep dive into the latest UBS U.S. Economics Weekly Report, the one titled Stall Speed.
That's the one, released August 1st, just last week.
Right. And our mission here is really to cut through the data and give you the essential insights. We're talking the first half slowdown, labor market dynamics, and the impact of these new tariffs.
A lot to unpack there.
Definitely. So this report paints a picture of, well, significant deceleration. What are the key numbers telling us this slowdown is, really happening?
Well, the headline figure is real GDP. It expanded just 1.2% annualized in the first half of 2025.
1.2%. That's quite low. That really sounds like the stall speed they're talking about.
It absolutely is. It suggests the economy is really sputtering, not just slowing. And then there's the jobs picture.
Okay, what did the July numbers show?
Non-farm payrolls increased only 73,000. And maybe more importantly, there were huge downward revisions for the prior 2 months.
Downward revisions. How much are we talking?
A total of 258,000 jobs revised away for May and June combined.
Wow. So what does that do to the trend?
It pulls the 3-month average for job gains down to just 35,000. That's very weak.
35,000 average. Okay. Now, we've heard some talk about maybe slowing population growth impacting labor supply. Does this report see it that way? As a supply issue?
No, actually the data points quite strongly in the other direction. The report argues this is a demand-driven slowdown.
Demand-driven. What's the evidence for that view?
It's inconsistent with an immigration-led supply shock scenario.
Right.
You look at indicators like the unemployment rate ticking up, it hit 4.248% in July.
Okay, rising unemployment.
Right. And the U6 measure, which is that broader measure of underutilization, that's climbing too. Plus, the labor force participation rate actually declined.
So fewer people looking for work and more unemployment. That doesn't sound like a labor shortage.
Exactly. It signals a slackening labor market driven by weaker demand, not a tightening one caused by too few workers.
Okay, so the domestic demand picture is clear. But then we have these new tariffs being announced. How significant are these really?
They are quite significant. The weighted average tariff rate on U.S. imports was hovering around, say, 16%.
And now.
It's projected to jump to about 19% by August 7th. This follows those recent executive orders.
Right, the reciprocal tariffs on places like the EU and Canada.
Precisely. For instance, 15% for the EU and a pretty substantial 35% for Canada on goods not compliant with USMCA.
Understood. So what does UBS project as the economic fallout from this? Growth and inflation specifically.
Well, for growth, they estimate a bit of a drag, maybe 0.1 to 0.2 percentage points off GDP over the next 4 quarters.
Okay, a noticeable drag, but perhaps not massive on its own. What about inflation?
That's likely the more immediate and significant impact. They expect core PCE inflation, the Fed's key gauge, to be pushed up considerably.
Pushed up from where to where?
From its current level around 2.8%, potentially up to about 3.4% by the end of this year.
3.4%. So that tariff impact flows through pretty directly.
That seems to be the expectation, yes. A direct cost impact.
Okay, so we have this awkward combination. Slowing growth, but also rising inflation pressure from tariffs. What does this mean for the Fed? We just had their July meeting.
Yeah, it puts the FOMC in a, let's say, delicate position. At that July meeting, they kept the federal funds rate unchanged, as expected.
But there was something else going on there, wasn't there?
Yes. Crucially, there were 2 dissents. 2 FOMC members actually voted in favor of removing restrictiveness, so essentially leaning towards easing policy.
2 dissents favoring easing. That feels like a strong signal. How often does that happen?
It's very rare, apparently the first time since 1993. And Chair Powell himself, in his press conference, did acknowledge the downside risks facing the labor market.
So even with Powell sounding cautious, do these dissents in the weak data suggest a September rate cut is still likely?
Despite the caution, the overall trend in the data is pretty weak. You've got the ISM Manufacturing Index below 50 for 5 straight months now.
Indicating contraction.
Correct. And real consumer spending has basically stalled out. So the argument for the Fed to start easing is becoming quite compelling.
And UBS is sticking to their forecast then?
They are. They're holding to their call for a 25 basis point cut at the September FOMC meeting.
Just September or more beyond that?
They actually see total cuts reaching 100 basis points by the end of the year. So 4 cuts in total.
A full percentage point by year end. That suggests they think the Fed needs to move fairly proactively to cushion the slowdown.
That appears to be the thinking, yes. Mitigating the risk of a sharper downturn.
Okay, so let's bring it all home. What's the bottom line from this report for you, our listeners, thinking about portfolios and planning?
I think the key takeaway is that the U.S. economy is clearly dealing with a demand-side slowdown. That's the primary driver right now.
But complicated by the tariffs,
Exactly, and at the same time, facing these direct inflationary pressures from those rising tariffs.
which means
Well, it implies you need continued scrutiny on corporate earnings, particularly for companies with high import exposure, and it strongly suggests the Fed is shifting towards an easing stance.
a Fed potentially easing policy in response to this persistent economic slack. Okay.
Right, which naturally impacts investment strategy considerations.
All right, a final provocative thought then for you to consider. As these twin forces, the economic deceleration and this tariff-induced inflation, continue to unfold, how might specific sectors or perhaps different industries adapt? Which ones look most vulnerable in this environment? And which ones might actually prove resilient or find ways to maintain their position? Something to mull over.